Jenny Banks, Director of Responsible Investing Advisory for NEI. Our team has known NEI for quite a while, and definitely their philosophy over the last couple of years. And this is why we're really excited to have you here today with us. NEI, I'll give a little more of the background on NEI, and then Jenny, I'll ask you to just give a little background on yourself and what brought you to responsible investing and NEI in particular. But NEI has been a leader in responsible investing and has a number of investment opportunities for Canadians and some really interesting products there that are, not only meant to be a net positive for the environment, but also to help provide some really competitive returns for the investors. So, we really love what they stand for and what they do. And Jenny, I'll let you kind of give a little bit of a background on how you got to NEI and your kind of journey to there.
Sure, and thank you so much for having me here today. So you can probably tell from the accent, I'm actually British, so not a native Canadian. So I spent most of my career to date working with institutions and financial services in the UK. I was an investment consultant at KPMG. I worked at Wellington Management, asset manager, and I moved to Canada in 2020, right in the middle of the lockdowns, actually. And I spent my first 3 years here working with First Nations. So that was an incredible introduction to Canada and Indigenous issues, which was something that I had honestly no understanding of at all coming from the UK. So that was a very humbling experience. But really opened my eyes to some of these issues. And, I saw the opportunity come up with NEI in 2023. It was not an area I'd been in before in terms of the responsible investing, but I have a long career, as I said, with asset managers. So taking that First Nations background, it felt like a good fit to move across. And honestly, I have no regrets. I've never loved the job more.
Wonderful. And what exactly does the Director of Responsible Investing Advisory, like what's the overarching role of that position?
Yeah, great question. So I effectively represent our responsible investing team. They have, coming on 40 years of experience in this space, and my role is really to sit with that team, see what they're doing, who they're talking to, what they're working on, and then help communicate that out to our clients, such as yourself.
It's spectacular. Looks like we've picked exactly the perfect person to have this conversation with. So I'm glad you're here. Would you help our viewers kind of understand what do we mean by responsible investing? Is the same as ESG, and what is ESG? Can you just give me a little bit of a background or history, or at least the lay of the land?
Yeah, of course. So actually, they're slightly different things. So responsible investing is the overall approach that we take to investing. So that is thinking about how we can ensure the companies that we invest in are going to continue to generate value in 10 years, 50 years, 100 years. So that's our investment approach. ESG is an acronym you see a lot in the news right now, and that is actually a lens or a framework that we use as responsible investors to analyze the companies that we're investing in. So that relates to environmental, social, and governance factors, and they could be risks, they could be opportunities that will impact the financial value of the companies that we invest in. So it's something that we draw on as responsible investors, but responsible investing itself is something of a broader framework, broader approach.
And has that changed over the years? Because it seemed like, when we first heard about investing in this kind of manner, it was ESG, and that was synonymous with environmental and just like this whole thing. And it seems to have evolved or changed, or is it a little bit different than what it was 10 years ago, let's say?
I don't think it necessarily has changed significantly, certainly not for institutional investors. I think for a very long time, they have been looking at environmental, social, governance issues that are relevant to their portfolios and their investments. I think in the retail space, what has really changed has been some of the communication and the language that we use around it. And part of that is actually clients are getting more sophisticated. They understand responsible investing more. They're coming across these terms such as ESG and responsible investing. And that really allows us to talk about the programs that we have in a more complex way, in a way that actually represents what we're doing. So, as investors, we are always looking first and foremost at the finances. That is our role, our fiduciary duty to clients. And we integrate our assessment of ESG factors because it helps us manage risks, because it helps us identify opportunities. By doing so, and some of the other things that I'll get to in our program, we are inherently creating positive impacts on the society and environment. I think historically, the industry lends a lot on playing to those positive impacts, which are really important to what we do. But they missed articulating the fact that this is driven from, fundamental sound investment case.
I would love if you would expand on that a little bit.
I was going to say the same thing. I think that's,
being that it is Earth Day, I mean, I think probably a lot of us on a day like today are just thinking, maybe we should invest in a way that doesn't screw up our planet. There's obviously a whole lot more to this than that. And if you could, share a little bit more about how you guys, like what are the opportunities or what are the risks beyond just we would like to have a planet to live on in the future?
Which is also important, but yeah.
Sure.
Well, it is. And that's the thing, if businesses depend on the resources that our climate, that our Earth provides us in order to run their businesses, in order to generate wealth. So actually, if we're eroding those assets, they won't be able to continue generating wealth in the future. So it is important to pick on an example. So thinking about the risk of climate and perhaps thinking more specifically about the risk of unpredictable weather events, because we're seeing lots of those at the moment, more extreme. So one of the things we would be thinking about as investors is how are our companies prepared to handle unexpected events? So if they have physical properties that are in floodplains, what are they doing to address that risk? Because that could be a significant source of operational, it could stop their ability to run their operation. Other things could be what we saw with the LA fires recently. There was, I think, 30 billion in insured losses from those wildfires. And as we're seeing, insurers are now pulling out of some of these zones where, they can't guarantee that they can insure these. So what are companies in those areas doing to protect against that? If you're running a huge multinational organization, that's a huge risk to your company if you can't insure a factory that's based out there. So these are all really material financial risks for companies. The flip side, as I said, there are lots of opportunities. So companies that are coming up with solutions to some of these things, we look at companies that are coming up with wildfire mitigation equipment or drought-proof seeds. We have a couple in our portfolio, just I can think of, that look at heat pumps. So doing heating, AC, HVAC, that type of thing, but it's improving energy efficiency. So there's going to be demand for that. There are building owners, there are companies who are looking to increase efficiency in their business and cut down on their energy costs. So a company that's actually providing solutions to that is really set to benefit from growth.
Yeah, and I think we saw that, same on, especially on the managed risk side. I forget how many years ago now. It feels like an eternity ago, but this happens often where the BP oil had the big massive oil spill, and this is something that happens far too often. And if they're not managing risk and not doing the right things and not hitting their ESG and responsible investing kind of targets, that also had a massive impact on their share price at that point in time. So it is, yes, taking care of the environment, but when these natural occurrences or unnatural occurrences happen, there is some significant risk to the shareholders and the investors as well. There was somebody recently, I think, was kind of saying that ESG risk is no longer just ESG risk. It's business risk almost, risk, and it needs to be kind of accounted for as well. And definitely on the opportunity side, and I think we're seeing some more opportunities coming because of the technology, and part of where I think people get that negative idea of ESG, it's a bit of a lag, right? Where I think 10, 15 years ago, solar was really expensive and the electric vehicle was just this ugly car that was only able to go around town. And now you're seeing some real great innovation. So these things that were kind of on the fringe 10, 15 years ago are now kind of mainstream and where the world's moving. So I think that's very, very interesting on that side. And I didn't have a question there, but just expand on that, because I think that is something where a lot of investors feel they look at it. We have a tough time as humans to evolve our initial thought process on something. And, I think there was a long time when, ESG was that feel good investment. And I think it's changed over the last number of years to something that is an important piece of a portfolio. So maybe you can expand on that a little bit and what you guys are doing on that side.
Yeah, and so I don't think that the feel good piece has changed. I think that's still there, and we can talk through other pieces of a program beyond sort of the ESG integration to explain why that's the case. So I don't think that has changed. I think it's more that this fundamental investment case, the importance of doing this that has always been there, is just being communicated better now beyond sort of the institutional investors who have been implementing that for some time. So talking about the components of a program, we're seeing NEI has been at the forefront of, as you said, of responsible investing for a long time. So we have a very established program, but we're seeing a lot of our peers now offer very similar pieces in theirs. And that could include things like exclusionary screens. So I think they're potentially the most basic form of implementing ESG considerations. ESG evaluation or analysis of companies, that's what we've just been talking about. That too is really core. But then we have these additional pieces that we can do called stewardship and policy advocacy. And that I think is where responsible investing gets really special. So on the stewardship side, we can vote at companies and we can vote against their directors at their annual general meetings to use our voice essentially on behalf of our investors to encourage companies to enforce changes. And similarly, we sit down with companies and we talk to them directly. We talk to their management. And, these can be really senior people. This could be the CEO of an energy company in Canada or whoever it is. And we have conversations to say, these are the risks that we see facing your business. What are you doing to mitigate those? And there's a few things that allows us to do. Firstly, it gives us the ability to influence change. So if we see that a company has risks and we're not sure that they're adequately addressing them, so climate being an obvious one, we can actually reach out and say, what are you doing? Do you have a transition plan in place? Because as your investors and on behalf of our clients, we want to make sure that you're set up to continue to be able to operate as you are in 50 years. If you don't have a transition plan in place, like what does that look like? And so that's a conversation we can have. It also just gives us the ability to understand what existing processes that they might have in place that aren't obvious to us, from a retail side and just by reading the news. So it means we can go really deep with our analysis because we can sit down and we can say, look, we see, your Amazon, you have data centers, you have them in water stressed regions. So what are you actually doing to manage your water? And they've published some stuff in a sustainability report, and that's all great. But we can have a conversation and go much deeper beyond that and say, actually, these are really meaningful steps that they're taking versus, just taking a report at face value. So I think that is really important, particularly now as, we see clients are concerned with things like greenwashing. That is where responsible investors can really support you with that, because we have the ability to go deeper and actually find out if policies and behaviors are meaningful.
So this sounds like there's a lot of value here in terms of this boiling down to the investor. Like it's a clear framework for the way you guys are managing the investments that are and are not in your portfolio, which overall is going to affect the opportunities and the risks that are there, represented all the way down to the individual investor. So I wonder if you can speak a little bit about returns. I mean, obviously not specifically, but I think there's sometimes a perception that responsible investing comes with either higher fees or lower results, because what you are actually getting there is a feeling, and you tolerate lower results in order to get that feeling in the way that you invest. And I'm not sure that that's true. I doubt that that's the way you would say it. And so I wonder if you could speak to like how does this actually come out when you boil it all the way down to returns?
Yeah, absolutely. And I think, being fully transparent, when responsible investing started, there probably was an impact on returns and fees. So I think it's understandable that people have this perception, but like anything, this has really evolved and come a long way and is really now quite mainstream. So there are lots of studies now which show that actually there is no detriment to performance from investing in responsible investing products. If anything, there's actually a correlation between better ESG management and then higher returns over the long term. Of course, we are long-term investors. That is entirely what we are doing because we are looking to protect wealth over the long term. So what I would say is there, of course, is difference in performance between individual products depending on your strategy. If you're in something thematic, you could have certain biases that could play into performance. So an individual fund will perform just like any other individual fund. Sometimes you'll win and sometimes you'll lose. But in terms of responsible investing as an investment approach, yeah, there's absolutely no impact on performance. And likewise, there's actually a study from 2024 Morningstar released one showing that there's also no impact on fees. And actually in Canada, on average, responsible investing funds are now cheaper than other funds.
Fantastic. That's interesting.
Jenny, you touched on a couple things right before that question, and I want to dive into a couple pieces just a little bit deeper. You touched on greenwashing, and that's something that we've heard a lot about over the last little while. So I'd love to hear just maybe a little bit more on what greenwashing actually is and what you guys do at NEI to help reduce that side of it. And then kind of like on that, and maybe you could just touch on this in part of this as well, is there's been reporting differences over the last while. And I know that, the different responsible investment bodies are trying to make reporting from corporations a little more succinct, and what I'm reporting for my environmental is also what company B is reporting, and how and it's still voluntary at this point. So how do we take the greenwashing and this whole, we're doing things for the environment, and have it in a way that is actually meaningful for you and for me as the investor, things that they say they're doing?
Yeah, so it's a great question. So to start, you asked me to explain what greenwashing is. So this is when companies or investors as well are portraying a product or service to have green credentials beyond what they actually have. So it's a misrepresentation of how green something is effectively. I think the industry has come a long way on this. So this is where investors really can lean on at your asset manager to be doing a lot of this work for you. As I was talking about with engagement, this is a benefit of us being able to have these conversations with a company and have sector experts who are doing the analysis, because they get to compare across all the companies in a sector and they can really drill into what is genuine and what isn't. And when they're reading policies, they can determine, this is something that looks really meaningful versus this is the type of policy that is more of a face, what's the word? Face value type thing. So that's the power of responsible investing. At an industry level, there has been a lot of regulation come out over the last couple of years. So I don't know if anybody would be familiar with Bill C-59, and I won't go into all the specifics on that because it's quite technical, but this is a change to the Competition Act in Canada, which will actually impact across Canada and is a huge piece of legislation which will really prevent companies putting out information which is not substantiated by international methodologies. So there has been a lot of change as a result of that. For example, we've seen a lot of oil and gas companies pull back some of the disclosures that they have out there while they get a better understanding of what counts as this international methodology. There are some really hefty fines attached to this. So if companies breach this law now, it will be financially impactful for them. So we are seeing changes as a result of that. The other thing you alluded to there, Trevor, is with corporate disclosures. So to sort of explain why corporate disclosures are, this is the disclosures that companies make in their financial statements and other regulatory documents that they release that investors use to drive our decisions. And we find them really important because if a company has to disclose something, the saying, what gets measured gets managed. So disclosures are a really important first step with a lot of responsible investing issues to get companies to manage some of these issues more effectively. And we see that now with climate and reporting on greenhouse gas emissions, for example, if a company's got huge emissions, they're not going to want to be reporting that. So it really does incentivize them to make changes in their business. So at a Canada level, there is work going on now to actually mandate, as you said, sustainability disclosures into financial statements. And actually, I'm really lucky to work with Adelaide Chu, who is our head of the responsible investing team here, as she actually sits on the Canadian Sustainability Standards Board. So that is the board that is doing that work at a Canadian level. So she has some really great insights for that from that. And yeah, this will be game changing. It's currently voluntary, as you said, but at some point in the future, we hope that it will be mandated, and it will drive companies to disclose a whole range of sustainability information that is relevant to us as investors. And actually, even though that might just target big multinational companies, if you think about a company's supply chain, everyone kind of gets impacted by that. So think about a Walmart. You could have a little Uncle Bob supplier, in a small province in Canada who's putting something through Walmart. And actually, if Walmart's about to be measured on a whole bunch of things, they're going to want their suppliers to come up to scratch as well. So this is going to impact business more holistically than just sort of those big ones that, are the names we see in the news. So that's something that I think is really exciting, and it's currently going through some regulatory processes at the moment, but we would like to see that those become mandated.
This is really Canadian centric, and obviously everybody on here is going to be Canadian. But is this same movement happening in the U.S. and around the world, or is this more a Canadian thing at this point?
Yeah, great question. And so Europe is really far ahead in terms of a lot of these things. They have a more robust regulatory reporting framework at the moment, is going through some revisions, but Europe is generally front of the pack when it comes to a lot of these issues. The US, perhaps not surprisingly, with everything happening with Trump right now, is falling behind. But a lot of these companies are, they're dual listed or they have operations globally, so they will get caught likely by existing regulations. An Amazon or a Walmart, as I said, is still going to be subject to Canadian, European, well, less so Europe, but they will be influenced by other regulations. Coming on to that point, though, about Trump and what's happening in the US, I think, again, this is a great opportunity for responsible investors to be at the table. So in an environment where we have deregulation, our voice is really important to keep the pressure on companies. And I'll give you an example of that as well. So if you think about AI, because that's everyone's favorite topic at the moment, are your kids using AI? Are you guys using AI? I'm dabbling with it. If we're Canadians and we're using AI, then we are exposed to these US tech companies. And what is happening is Trump is deregulating the industry because he wants to be able to compete with China. And that means that certain things like digital rights and protections around misinformation and how AI is actually rolled out to us as end users, they're missing. They are actually in the EU, they're captured by the EU AI Act. But in the US, those are sort of being lifted and companies are being allowed to run wild a little bit from a policy perspective. So our voice as responsible investors is critical to sit down with these companies and say, we want to see digital rights. We want to see protections for end users. We want to see that you're thinking about how AI is being implemented in a way that will be fair to everyone. And so we're actually sitting down with Microsoft. They own OpenAI, who owns ChatGPT. We're sitting down with Alphabet and Meta and all of these different companies to raise this and to say, this is something that's really important to us. We invest in you. And it's not just us, there's other investors too, who are doing this. So keeping the pressure on companies where there is deregulation is really important.
Oh, that's so interesting, that just the concept that investors can, fill a gap where regulations might be falling down or missing. Yeah, very interesting. And that's kind of where I wanted to go with this next question as well, is just the like I guess there's an idea that more regulation is bad for business, and that's certainly the argument that's going on at the moment in the U.S. But there really seems to be this kind of opportunity where additional regulation, forcing disclosures from companies in a standardized method, should make your job, NEI's job, easier in terms of managing those risks related to ESG factors in the portfolios. And to the extent that good information about those risks and opportunities can allow you to build a better portfolio with a better risk adjusted return. This is actually like a direct line between more regulation could lead to better outcomes, both for the companies and then ultimately for the individual retail investors that hold them through companies like yours. Am I right there?
Yeah, exactly. So, we don't want regulation just for regulation's sake. We want it to be thoughtful and to be targeting these areas that we see as being key risks or opportunities for companies. But it is really important. It does put pressure on companies. And actually, that was the fourth pillar of our program, which I didn't sort of expand on earlier. But we do a lot of work as well at a policy level. So we're actually working with policymakers, regulators, governments in Canada, um, again, to put forward that investor voice and to say things like diversity disclosures, as an example, are really important to us. There's actually a correlation between companies that have more diversity and their performance. So we want our companies to be diverse and to perform better. That just makes business sense for us. So let's put some disclosures in place so that we can actually see which companies are diverse. So that's something we spent a lot of time talking to the government about, and various regulators. But yeah, that's one example. But we're doing this across a whole range of issues, including general sustainability disclosures. So again, that work with the CSSB, that's something that we're also putting forward in this space to say this is important. We want to see this mandated. Yeah, does that answer your question?
Yeah, I think so. Yeah. And overall, I mean, is responsible investing growing as a category? It's obviously not an asset class. It goes across asset classes, but is it growing still as a category in terms of assets and in terms of media attention and that kind of thing?
Yeah. So we saw 2022, I think, was really a year where a lot of people moved into this space that hadn't previously been there. So we saw huge growth. I think 2024, there's been a slight reversal in that, which is not something that we're too concerned with because it does represent sort of a maturation of the industry. So it's not a new flashy toy. It's something that is really established now. And, with some of the rhetoric that's been going on in the world, it's not surprising that that has had an impact on investors, which is unfortunate because we get to see behind the headlines to what's really happening, and I think the headlines do give very misleading perspective on this. But so we've seen a little withdrawal, but actually assets are at an all-time high. So I think at the end of 2024 there was 56 billion in Canada in responsible investing assets, and actually from NEI's own experience, we're just seeing our assets increase. So I do think this continues to be an area that interests people, and as I hopefully have explained, is really just enhanced investing. So it's just what you do elsewhere, but with these additional protections and value add pieces in there as well.
Yeah, it definitely seems like it's something that the high net worth and institutional investors have understood for a while. I was looking at some numbers not that long ago, and the amount of what would be considered, responsible investing inside, the ultra high net worth, it continues to increase every year. And when they put out the polls at the beginning of every year, more and more of these family offices and institutions are looking to add, not subtract from this type of investing. So, it definitely is something where, maybe on the retail side, we're reading the headlines, but when it comes to, the bigger institutions and pension companies and things like this, more and more money is going into that. And I just wonder, kind of touching on what you just described as definitely some headwinds come in with, I think especially what we're seeing from south of us, but we're also seeing this, throughout different parts in Europe and around the world, where the leaders and leadership has moved pretty far right, as opposed to more left or left center, which is really where, without getting too political, is really where the environmental and, responsibility and sustainability kind of comes into play typically. Are you seeing some headwinds coming from that? Are you seeing this affecting like responsible investing over the short or midterms because of these political changes?
Yeah, so it has definitely had a chilling effect, I would say, in certain areas. So I mentioned diversity previously. That's an area where in the US there has been a lot of noise from Trump about this concept of illegal DEI. I don't know what that could possibly mean, because what is illegal diversity? But he has been putting out executive orders to, wind back diversity in federal government. He has been, or there have been a lot of lawsuits going on there. So actually, what we see on the ground, though, is it's part politics and part noise there, but there are some underlying things behind that, and what companies are doing in response is not necessarily what people think. So with the US and that example, this was driven by a Supreme Court ruling in 2023 that Harvard couldn't have admissions targeting diversity and sort of affirmative action. And since then, there's been a lot of lawsuits against companies in the USA for what they call reverse discrimination. And so I think there's been over 160 lawsuits now. And so what we're seeing is companies are really, there's been a lot of headlines around companies dialing back or rolling back on their DEI commitments following this. But what we're seeing on the ground is actually this is in response to legal challenges, partly in response to political pressures, but we're not actually seeing companies substantively reverse course on their DEI initiatives. What they're doing is tweaking language around it to be careful of the lawsuits and to sort of somewhat play to the politics. But the fundamentals, as I just said, it makes sense to have diversity from a business perspective. The fundamentals haven't changed. And actually, what we're seeing is companies generally remain committed. Now, there are some where this has really, I guess, highlighted the fact that they didn't have robust policies in the first place. And actually, that's not necessarily a bad thing, right? Because that just says to us, okay, you weren't doing what you said you were doing, and we'll treat you a bit differently. But in the main, most companies are really committed. And so this concept, I think, to your question, really plays out with a lot of the politics. Politics and business fundamentals are two very different things. There can be this chilling effect on how companies communicate. Climate is the other one. There's been a lot of banks, a lot of asset managers, and different groups moving away from climate alliances that were in place. That doesn't necessarily reflect the fact that they're not committed to their climate targets. So, we're talking to all of the Canadian banks. A lot of them pulled back from one of these alliances at the start of 2025. And we've actually sat down with all of them to say, what are you actually doing? Does this impact anything? And by and large, it doesn't. And we remain fairly confident in what they're doing and their own individual plans. So, yeah, politics are important because it means that the way that we communicate things has to change. Actually, in the retail space, it's really hard because it's creating this very polarized view of what ESG is and what we're trying to do, which actually is nothing at all related to everything I've just been talking to you about, which is the fact that this is just fundamentally, sound investing, wanting our businesses to manage themselves effectively. But the politics really drives this misunderstanding. So it can be really hard, I think, for people on the street to divorce what they're seeing in the headlines from what the reality is. And that's why what you guys are doing here is so important to hopefully help dispel some of those myths. But what we're seeing in terms of, our conversations with companies and what's actually happening on the ground is fairly comforting. The other thing I would add to that, Trevor, is in the climate space, money talks and money will continue to flow to where there are opportunities. So, for example, renewables, Trump's making a lot of noise about renewables, but it's the cheapest form of energy. So companies are going to continue to put money to the cheapest form of energy, especially as we expect demand for electricity to continue increasing with AI, data center use, EVs, all of these things. And interestingly, in the US, actually, the red states tend to be the biggest renewables states as well. So Texas, I think, is the biggest renewable state.
I read that recently too. That blew my
Yeah,
mind. I'm like, yeah, Texas is, I think, one of the biggest, if not the biggest in the US for, it's so
it's
interesting.
so interesting. And they've really benefited from that, from the investment, from jobs. And so, there's fears that Trump will roll back. There's this stimulus that Biden put in place, the Inflation Reduction Act, which has sparked a lot of this investment. People are worried that Trump will roll back that. I don't think he will, because it's benefiting these states. There might be some tweaks again to tax incentives for companies and things that make it look like he's making big actions, but the reality is the money is going to talk. So
we've been talking a bunch here about like equities and companies. And so like when you boil this down to the individual investor's perspective who's trying to build a portfolio, probably with our help, and if responsible investing is something that's resonating with them, is there anything that, any asset class or any part of the business where responsible investing is underwhelming? And I'll ask you that's probably not what you're supposed to talk about when you represent NEI, but I'd like to know if you have an opinion there. And then just generally, are we at a point now, and I know the answer, but are we at the point now where we can build a good quality diversified portfolio for any risk tolerance that is 100% responsible investing focused?
Yeah, so I'll start with the second part first, because the answer is yes. We've got products for, and not just NEI, as an industry, there are responsible investing products for every asset class, sector, region, pretty much. You can be covered. There's different types of approach. So, you can have your very core mandate, so your equity fixed income products, and then you can have more thematic or impact oriented products, and that's where you're really directing your money to flow to specific areas. So core would be standard global equity or whatever you have in that bucket, but a thematic could be putting money towards climate solutions, clean energy, that type of theme. And impact is where you actually really are making an intentional positive impact on the society or environment. So interestingly, that impact bucket, I think, is what people conflate with responsible investing generally, but that's the bucket where there's this intentional positive impact. So there's a sort of a spectrum there, and that is where are you putting your money? But then the how are you using your money, or how are you leveraging your money? That's all the different tools that I was talking about. That's the exclusionary screens, the evaluations, the stewardship work, the policy work. That can apply across any of those. So you can always have that how is my money working to improve things, to influence change. That can apply to any fund that you own. And then the where is my money going? Well, that really depends on your preferences and the types of growth opportunities you might be seeking, or the types of impact that you might want to be having. So to the second part of your question, to the first part, we basically, I think NEI is one of only 2 or 3 alternatives funds that are available in the market that have a responsible investing tilt. So that's one area which is less served by responsible investing. And the other thing is we really are long-term investors. So something if you're looking for short trading-based ideas, that's not really going to be as relevant for responsible investing. But I say that carefully because we have a long short equity fund, and that's not to market this, but that is actually quant driven, but it has responsible investing built in. So there are ways that the two can be married together, but I would say generally short term focused funds are not where you're going to be seeing this space work. But generally, I think most people's portfolios are long term intended anyway. So
yeah, certainly our clients, like day trading is not what we do for our clients. And so, there are folks out there that do that, and that's fine. That's not us. So yeah, I think our audience here will resonate with the idea that like retirement's a long time for a lot of people. And so the long-term approach to investing is what's going to work.
uh-huh.
So you've mentioned exclusionary a couple times, and when you're talking about that, is what you're meaning by exclusionary criteria like if we sell guns that would be excluded from the portfolio, or if we do these different things, like how does that work into how you guys build a portfolio, or how your fund managers build portfolios?
Yeah. So well, on NEI's side, we have firm-wide exclusions for the tobacco industry and then weapons. So that could be handheld weapons and controversial weapons like cluster munitions and nuclear weapons. So a firm-wide exclusion means that no company that is producing or manufacturing in those industries can be eligible for our funds, and that's also applied by our sub-advisors as well. We also have additional revenue-based screens around those. So tobacco is a great example. The revenue-based screen is for companies that distribute tobacco, and they have to have less than 10% of their revenue generated from the distribution of that industry. So that allows us to have things like the Walmarts and other types of stores in our portfolios, because actually that portion of revenue would be so immaterial for those companies. But the reason we do this is because we organize our program based on global norms, so business responsible investing norms, and these are focused around guidelines such as the OECD guidelines for multinational enterprises on how to be responsible businesses, and we've looked at those, and then we've said for these industries there is no inherent good that can come from these industries, and there is no amount of engagement that we could have with those that would impact their business model in a way that we would find acceptable to hold in our portfolios. And tobacco is a great example, because actually if you look at how tobacco has performed, it's really underperformed over the long term versus I think I have an ACWI chart somewhere, but in short term, you might see, little spikes that we miss out on, of course, but over the long term, it's underperformed. And our risk in our portfolios has been better for excluding it. And then you see things like the other day there was the settlement, I think 32 billion settlement across major tobacco companies in Canada for past harms that they had caused people, and you think, why would I ever want my money to be going into a 32 billion fine, right? There's such an inherent risk with that industry that why would we put our money to that? There's no benefit to doing so. So that's really where we have exclusions. We keep those pretty light, actually. We focus on the tobacco and weapons. For other industries, I know historically responsible investing was seen as a values-driven approach, and so some people want to see things like gambling exclusions or other areas excluded in there. We actually prefer to be able to evaluate companies on a case-by-case basis, because that enables us to say, this company has some really severe systemic risks or company-specific risks that we don't want in our portfolio, but this one actually, this is a high-end resort playing to wealthy people who want to have a casino. It's not actually damaging at-risk, lower-income populations, and so maybe this one is something that we can make eligible. So we want to have that ability to do a deep evaluation. That's why we have sector analysts. That's why we have all this deep expertise. And so doing the ESG evaluation, we find to be more effective. So we limit the exclusionary screen.
I was going to ask you now, like, there are other companies that do responsible investing in Canada. NEI is a big one, and you represent NEI. And so, here's the chance to give us the sales pitch. You just mentioned a couple of things that I think are part of what makes NEI particularly special. Is there anything you would add there about, why NEI?
Yeah, so for me, I think it's partly our track record. We have been doing this a long time, and track record in and of itself doesn't mean anything, but actually for us, it means that is 40 years worth of building relationships with these companies, of building this expertise, of identifying risks and opportunities ahead of others. So it actually really does give you a leading edge in this space. But the other thing is we have influence beyond our size. So, we're relatively small compared to some of the asset managers in Canada, but we have access to global sub-advisors, some of the best sub-advisors in the world. And that means actually some of the smartest investors in the world as well. And we bring those to Canada, and they're asset managers that Canadians wouldn't otherwise be able to access. So a lot of those sub-advisors actually have their own responsible investing programs as well. I mean, to give you an example, Amundi is the largest asset manager in Europe. They have a team of 70 in their responsible investing team, and they're doing all the same stuff that we're doing as well. So you're kind of doubling up. You get all of that expertise, and then you get our expertise as well. We have an in-house RI team that I've been talking about a little bit there. So we have 10 people in our team. And as I said, we have some deep sector expertise. We have stewardship professionals, and we just really have great relationships with particularly a lot of Canadian companies, but actually globally as well, a lot of companies. And then the final thing I'd say is just in terms of influence, because we've been in the space so long, because we have this expertise, people come to us for insights. And this is something that I think is our secret sauce. So I mentioned, a lot of the policy work that we do. We actually have governments, we actually have regulators and policymakers reaching out to us for our inputs on certain topics. And I think that is really unique in the way that we cover such a breadth of topics as well. And this happens a lot. It's not just like the odd one-off occasion where this happens. So I think that's really special because it means we actually can have an influence on behalf of our investors. So while we are small, our voice is loud and people actually respect what we have to say. So companies do change things because we're having these conversations, and policymakers and regulators do listen to our input. So yeah, that is what I think is special about NEI.
Speaking about loud voices, and you've been chatting with us for over 45 minutes here with your voice, sounding pretty darn good considering. So we'll start wrapping this up here, and I just, is there anything that we've kind of missed that you would just like to kind of add, about the space, about this type of investing?
I think we've covered a lot of it. I think really the summary is some of the points that we've already touched on, which is beware the headlines. They are designed to scare. And actually, never before has it been as important to have responsible investors at the table. We have to keep our voice out there. We have to keep the pressure on companies. There is a lot going on in the world. There is a lot of competing pressures. And so our voice has to be loud and clear as to what is material to us as long-term investors, because fundamentally we're doing it for you, for your clients' money. We want them to be able to generate wealth. We want their children to generate wealth and their grandchildren to generate wealth. And we want that to be something that can continue indefinitely. So having our voice there and keeping up that pressure is really, really important.
Jenny, this has been awesome. Just such an excellent conversation. You've been totally wonderful to speak with. Thank you for bringing your expertise. I think our audience will have appreciated this conversation as well. There was so much covered here, so thank you very much for that. For the audience, if you do have any questions you want us to pass through to Jenny, we're happy to do that. Easiest way to do it is just email either Trevor or I, and we will pass that along and get you an answer. We're certainly happy to have that conversation with you as well. So if you want to talk more about investing in general or how this would apply either to your existing portfolio or instead of your existing portfolio, either way, that's a conversation, of course, we would entertain. And we're happy to involve Jenny where it makes sense and where it's reasonable. But certainly we can pass those questions along. Jenny, thank you again for joining us. This was great.
Thank you. I really enjoyed it.